Okay, this video is a focus on open market operations. So if you remember from the last time you took some notes, you took notes that included these chart on monetary policy tools. We talked about the three ways that the Federal Reserve can change the amount of money that is available. Well, one of those was open market operations. And so I wanted to focus in on that and how it impacts the T account. So this is kind of revisiting the T account here. So first off, I want to point out to you that the first time we were talking about the T account, and when you guys did that T account of the ABC Bank, that was for commercial banks. This is for we did it for one bank. But here, we're going to talk about commercial banks as a whole. This is like all commercial banks out there, okay? And then we have a separate T account for the Federal Reserve. So the Federal Reserve has their own T account. So what I would like you to do is in your notes section of your binder, underneath your notes that talked about monetary policy, and the last thing you wrote was about the federal funds rate in there. I want you to copy these two charts. Okay, so take a minute if you need to pause the video, copy these two charts. You need that many rows. And I left big spaces because I'm putting words in there, but you really don't need that big a space. Okay, hopefully you copied those two charts. All right, so first thing that I want to kind of give you a heads up on. Remember when we talked about commercial banks, we talked about assets and liabilities. And so assets were anything that the bank owned or was owed. And liabilities were stuff that the bank owed to someone else. All right, so what does that look like for the Federal Reserve? Well, what are their assets? What are their liabilities? Well, for the Federal Reserve, their assets are going to be treasury bills if they own them, because remember we talked about treasury bills are a good thing. Anybody who owns them, when they come due, the Treasury, the US Treasury is going to pay them. That includes the Federal Reserve. Okay, so they're an asset. Okay, it's a financial asset. But also an asset to the Federal Reserve is any loans they make to commercial banks, because those loans, right, are going to be ones that the commercial bank has to pay the Fed back, right? So that means the Fed's going to get money on that. Now on the liability side, any currency in circulation, so any amount of money out there, is a liability for the Federal Reserve. Because if you actually look at our currency and our bills, it says at the top, Federal Reserve Note. Okay, that means that these are liabilities that the Federal Reserve put this out there in circulation, and that means that they're owing that money to people. Okay, it's kind of a weird thing, I know. Also, a liability is any money that commercial banks puts in the Federal Reserve. Those bank reserves are going to be a liability of the Fed. Bank reserves, think of bank reserves as the bank's quote unquote deposits, savings. So it's the equivalent of, the general public putting our deposits, our checkable deposits, into the commercial bank. Bank reserves are like that. And then also the government's money. So any money that the federal government puts into the Federal Reserve, that's also a liability of the Fed. The Fed owes that to the federal government. Just like, again, deposits that we put in our bank. The only other thing that I want to add over here with the commercial banks is that keep in mind that we already know the assets of commercial banks. We already talked about the bank reserves. We talked about loans, but also treasury bills will also be an asset to commercial bank if a commercial bank owns a treasury bill. But also liabilities are loans from the Fed. So loans from the Fed are also going to be a liability, because that's something that the commercial bank is going to have to pay back to the Fed. So not only is a liability going to be those checkable deposits that we've already talked about, but also they have to pay back any of those loans to the Fed. Okay, so that said, let's take those off for a second. Okay, and if you wrote those in there, then you're going to have to add another row. But I want to go through, what does this look like, those open market operations, when we buy or sell T-bills. So how does that impact the T account? So the first thing is a purchase of $50 million in treasury bills. So if the Federal Reserve is purchasing $50 million in treasury bills, what happens? All right, first off, that means that the Federal Reserve is getting more treasury bills. So that's going to increase their assets. So it's going to be plus 50 million in treasury bills, right? But at the same point in time, if the Fed is buying those treasury bills, okay, it is also going to be putting that $50 million back into the monetary base. What that means is the monetary base is that's going to be our reserves with our commercial banks. Okay, so over here, the commercial banks are going to lose 50 million in treasury bills, and I should have specified this would be assuming the Fed is buying all of these treasury bills from commercial banks. But reserves are going to go up by 50 million. Keep in mind that when I say monetary base, remember monetary base includes the reserves. So reserves going up by 50 million here is also going to be increasing the monetary base over here, which we already said was a liability because, hey, these reserves of the commercial bank may be held at the Fed. I know that sounds confusing, but notice how, again, assets equals liabilities. So I added 50 million here, I added 50 million here. Notice over here, I didn't do anything to the liabilities. There's no change to liabilities, right? Didn't change my deposits, didn't change my loans from the Fed, but it did change how much reserves I have and how many T-bills I have, which are both assets. So if I plus 50 million here, I could minus on this side, okay? So what it would look like if the Fed sold 50 million in treasury bills. Well, obviously it's the opposite, but let's go through it anyways. So first off, the Federal Reserve has 50 million less in treasury bills, which is an asset to them. Which means if they're selling T-bills, they have less T-bills, which means the money had to come from somewhere to pay for those T-bills. So 50 million less than the monetary base, which is our reserves. So the commercial bank gets 50 million more in T-bills because the sale of T-bills, the Federal Reserve is selling T-bills. So the T-bills go from here to here. And in order to pay for them, okay, the reserves are 50 million less, which means the reserves are less, or 50 million less over here, which is the monetary base. I should have labeled that as reserves as well. Okay, hopefully that makes sense. Okay, and keep in mind there's no change over here to liabilities for the commercial banks because deposits didn't change and our loans from the Fed did not change either. The only thing that I will say that could be different is that if the Federal Reserve is buying and selling from the public, because if they're buying and selling from the public, then the public will pay for those T-bills with their checkable deposits. So then you change their liabilities and then you change reserves, but you would not change treasury bills. Okay, so let's give this a shot. On Canvas, in this unit, you will find a worksheet that says T accounts revisited. All right, so what you're going to do now is that you're going to do these 3 examples. So it says, in the table below, you find consolidated balance sheet for commercial banks and the 12 Federal Reserve banks. So this is the Federal Reserve T account. This is the commercial banks T account. And remember, when I say commercial banks T account, we're talking about like collective commercial banks, like all of them, okay? And it says that what you have to do is you have to use columns 1 through 3 to indicate how the balance sheet would read after each transaction is A through C is completed. Do not accumulate your answers. That is, analyze each transaction separately, starting in each case from the figures provided. All accounts are in billions of dollars. So part A is going to be in column 1. Part B is in column 2, part C is in column 3. And every single time you're going back to the original numbers that are printed over here so they're not accumulated, okay? Keep in mind that the changes, you're not going to see changes to all of these numbers when you go through A, B, and C, okay? Be very careful. There is a difference between B and C, okay? All right, so please do that, and then we're going to add this to our binder. All right, that's it. Let me know if you have any questions.